Welcome to Oraculum Accounting. In this video, we will briefly understand organizational structure and hierarchy, and how businesses organize people, departments, and responsibilities to ensure efficient operations and clear accountability. People structure in business: roles, responsibility, and reporting lines. The people structure of a business defines how individuals are arranged to perform work, make decisions, and maintain accountability. It clarifies who reports to whom, how authority flows in the organization, and how responsibilities are divided. In most organizations, the structure begins with senior leadership who set strategies and monitor overall performance. Below them are managers who coordinate teams and ensure that departmental plans are implemented effectively. At the operational level are employees who perform daily tasks and support routine business activities. A clear structure reduces confusion, improves communication, and ensures fair evaluation of employee performance. For departments such as accounting, finance, and taxation, an effective structure is especially important because it ensures proper segregation of duties, strengthens internal control, and helps the business meet regulatory and reporting obligations with accuracy and transparency. Business hierarchy from bottom to top, based on functional flow of departments, frontline and operational staff. At the base of the hierarchy are frontline and operational staff. These employees perform daily operational tasks such as customer service, warehouse handling, distribution, production, packaging, and administrative support. Their work supports the daily functioning of the business. Technical and specialist personnel. The next level includes technical and specialist personnel who provide expertise in areas such as quality control, logistics coordination, accounting support, human resources support, and sales operations. Their role is to ensure accuracy and efficiency in specialized activities. Supervisors and team leaders. Above, specialists are supervisors and team leaders who manage operational teams such as warehouse teams, production lines, service teams, or sales groups. They monitor employee performance and ensure procedures and targets are achieved. Department managers. Department managers oversee major functional areas of the business, such as marketing, finance, human resources, procurement, operations, logistics, and customer relations. They coordinate resources and monitor departmental performance. Senior functional managers, or heads of department. Senior functional managers supervise multiple units within a department and ensure that departmental plans align with organizational objectives. They also manage budgets and implement policies. Executive leadership. Executive leadership includes senior executives, such as the Chief Executive Officer, Chief Financial Officer, Chief Operations Officer, or Managing Director. These leaders determine organizational strategy, risk direction, and overall performance priorities. Governing body or owners. At the top level are the governing body or owners, including board members, shareholders, or proprietors, who provide oversight, approve long-term direction, and hold executive leadership accountable for results, reporting lines, and departmental responsibility. In a structured organization, employees communicate through defined reporting lines rather than approaching senior leadership directly. This ensures that information flows in an organized way and responsibilities remain clear. For example, a packaging worker normally reports to a packaging supervisor or production manager, who may escalate issues to higher management if necessary. This structured reporting system protects managerial accountability, prevents confusion, and allows each level of management to perform its coordinating role effectively. When employees clearly understand whom to report to and how departments interact, communication becomes more efficient and organizational control becomes stronger. Step-by-step model from operational need to CEO level approval. First, a department identifies a need, such as equipment, services, software, or materials. Next, an internal request or purchase requisition is raised, describing quantity, specifications, urgency, and purpose. A supervisor reviews the request to confirm accuracy and necessity. The department manager then approves the request if it fits departmental plans. After that, the inventory or warehouse team checks whether the item is available in stock. If the item is available, it is issued from stock and the request is closed. If the item is not available, the request is forwarded to procurement, where suppliers are evaluated and quotations are collected. The finance department then reviews the budget and cost impact to confirm funds are available. If required, compliance checks, such as tax or legal review, may also be conducted. For large purchases, senior management reviews the request. If the value exceeds approval limits, executive leadership or the CEO provides final approval. Once approved, procurement issues a purchase order to the supplier. When goods arrive, the warehouse verifies them against the purchase order. If necessary, quality control checks the product standards before acceptance. After verification, inventory records are updated and items are issued to the requesting department. The supplier invoice is then processed by accounts payable by matching the invoice with the purchase order and delivery records. The correct tax treatment is applied, and the transaction is recorded in the accounting system. Finally, the finance department approves and processes the payment according to the agreed terms, and the cost appears in management reports and financial statements. Interdepartmental communication and external linkages of finance, accounting, taxation, and audit functions. Finance, accounting, taxation, and auditing functions operate at the center of organizational communication. These departments collect and interpret financial information from internal departments such as operations, procurement, sales, human resources, and management. At the same time, they maintain relationships with external bodies, including tax authorities, regulatory agencies, auditors, financial institutions, and government organizations. Through these interactions, businesses fulfill statutory reporting obligations, comply with taxation laws, and ensure independent verification of financial statements. Effective communication between internal departments and external institutions strengthens transparency, reduces compliance risk, and supports informed decision-making across the organization. Conclusion: understanding organizational structure helps businesses maintain clear roles, effective communication, and better coordination across departments. For more informative content, subscribe to our channel.